So, welcome everyone to another in our, well, it was a new series. It's now a series of Q&As, questions and answers with the advisor team here at Philip James Independent Financial Advice, Kendra Seltzer and Louis Hammond. Welcome both of you. And the idea here is that we talk about and answer for you some of the real questions that we're asked on a day-to-day basis because we're all seeing clients um, every day of the week. And well, some common themes often emerge in the areas that we discuss. So Kendra and Louis have had to think about one or two of the things they've been talking about in the last week or two. Um, and well, let's start with you, Louis, and you had some ideas of one or two things I think to discuss, and we can all add our experiences and see how that helps.
Sure. So something that's come up very recently and actually does come up periodically is the idea of clients running their own investments, doing it's what we would call DIY versus employing an advisor to do that for them. And what are the merits and demerits of that? As I said, I had a very recent conversation with a client about this only yesterday. And it's a really good question. So I think from my perspective, one thing to consider is, do you want to do it yourself genuinely? If you do really want to do it yourself, then you will save cost. And this is normally where this question is coming from. It's predominantly a cost question. Why pay someone else for something I can do myself? And you'll find that in all areas of life. You can paint your own walls. You could probably cut your own hair if you wanted to. So it's a good question. I think if you are very confident doing it yourself, then yeah, you could absolutely do that. You will save a bit of money. The question to genuinely think about is, do you want to do that? And what will be involved in that? Where are you going to invest? What are the returns going to be? Do you want that responsibility, or would you rather have somebody else come in and do that for you? Are you going to act on the things you know you should do? Or like a lot of jobs that, personal jobs in people's own lives, they get put on a list and then that list gets kicked down the road again and again and again. And what's going to happen? What's the opportunity cost, I suppose, for not doing that thing you know you should do? In a way, might it be better to just, yes, pay somebody else to do it, but know that it's done, and then you can relax? So I think as advisors, we can't hide behind that question. We just got to be upfront. We do charge for what we do. Of course, we have to do that. And it could be cheaper if you did it yourself, if you genuinely want to do that. So I don't know what experience you guys have had with that same question.
Yeah. Kendra, is that something that's been asked of you?
Yeah, absolutely. We get it quite often, but I think what advisors do is they provide peace of mind and a sounding board, not just to the clients, but their families too. If something was to happen to them, they know who to turn to. So I think all of these different parts are to play with that. It's having someone to say, am I doing the right thing? Is everything as it should be? And just having a couple of meetings a year to say, yes, everything's on track. Is the client who DIYs it themselves, are they going to be checking that the performance is in line with their risk level and against the indexes, suitable indexes, that is, as well? Are they going to be disinvesting when markets get volatile? We provide the peace of mind, whereas people who DIY it themselves almost they have to make those decisions and they might be getting it wrong most of the time. So they've got to be quite conscious of that and be experienced and know what they're doing.
I think one word you mentioned in there is the very important one, and that's plan. And I think what we don't do is just organize investments for people. Yes, we do, and we find portfolio managers who are going to make the right decisions, be in, be out of the market, where to invest, and so on. But the most important thing, I think, is that we start with actually making a plan. And that might be, how much do you need to retire? That might be, how much income do you need and how do you take it out of your investments? It might be just organizing what people have in a more efficient way because particularly as time goes on, having a lot of complicated bits and pieces all over the place um, can become um, a nightmare. Particularly the case in couples, I find if one of the one partner is really into all this stuff and does a lot of DIYing, and yeah, I mean normally that's going to be, I'm afraid, still the man, but then if they become less capable, and I've had this over a number of times over the years, less capable or sadly die, then whoever's left has got a heck of a mess to sort out and often doesn't know where to start. So yeah, and you use something I often say to people is you can DIY anything. You can do your own plumbing. Actually, a good example for me is booking your own holidays, because that now, in theory, you can book your flights, you can book your transfer online, you can book your accommodation. For me, I would actually rather pay an extra 10% on the cost to a travel agent. I use a travel counselor to just say, just do it. I don't want all the hassle of all of this and then get my boarding passes for me. And in a way, that's part of what we do for people is we are the travel agents in your financial life. Just thought of that, so I'm going to coin that phrase. So
One other thing I'd sort of just add to that is one thing, it's sort of an adjacent issue, I suppose, but sometimes when we talk to clients about investing, you when they talk about things like stocks and shares, it can sometimes trigger a response of, oh, I'm a bit wary of that. I've lost money on that before, or I've got a friend who lost money on that before, and things like that. And when you delve into the detail, often what's involved there is entering the market at the wrong time and exiting at the wrong time, potentially, and or those two things. And essentially what's behind that is, consumer behavior. A lot of the time we see something going up and we think, oh, it's going to go up forever. We want to buy that. And then actually it reaches its peak, it comes down and we think, oh, we better sell it. And so you can end up sort of buying on a high and selling on a low. It's not what you've bought that's the problem. It's when you've bought it and when you've sold it. And we're all like that to an extent. I think when it's your own money, you feel that risk is more visceral, and it leads to these kind of outcomes where buying and selling at the wrong time. If you have an advisor, in my opinion, you're sort of taking a step back. It's in someone else's hands, so to an extent, you can leave it to them. And generally speaking, there are perhaps some examples where this may not be the case, but generally speaking, our attitude is to buy it and to hold it long term and ride out these peaks and troughs. And that's going to mean you're not selling at the wrong point and sort of crystallizing a loss. So sometimes taking a step back and bringing someone else in can just cool that decision making a little bit. And longer term, Vanguard did some very interesting analysis on this, which they call the advisor alpha. Longer term, they think clients that have advisors do 3% better per year, because purely, not because of what you're buying, but purely behavioral based. And that behavior is just a little bit easier when it's somebody else's responsibility and not yours.
yeah, and I think it's one of those behavioral things is that people are much more worried about losing money than making money. And that's where the panic happens when people move out. But I think a very important part of that is something I know that Kendra was going to talk to us about, which was is keeping enough in cash, which is always part of the plans that we put together for people to make sure that when things go down, which they always do if you're invested in the stock market or invested anywhere that's going to earn you more than having money in the bank, that you don't have to cash things in. So, and I know you've had conversations with people about this, Kendra, haven't you, recently? So, to tell us a bit more about how you approach that with clients.
Yeah, absolutely. So this is particularly important for clients who are entering decumulation. So when they start to draw assets out, or just before, so it might be 1 or 2 years before they might look to retire. I have this conversation quite a lot with clients, and money is very emotional. Some clients are very comfortable with having £5,000 in cash as a cash buffer, or some even less. But also we have some clients that hold a substantial amount, over £100,000 in cash, because they think, oh, I'd rather have the money they're available should I need to. Now, obviously, if you're holding high amounts in cash, you've got to be careful of inflation because it's eroding in real terms in the bank because you're not getting 4-5% interest anymore. You're getting 2 to 3 really in accounts. But so that's something to be mindful of. But it's making sure that the clients that do enter into this accumulation phase have cash assets to fall back on should markets fall substantially. There is likely to be a market correction, but again, we can't tell you when that would be. So it's just really having that fallback to say, right, I don't need to take money out when the markets are low because I have X amount in cash should I require it, should my roof need fixing, should my car break, for example. It's just having that buffer there should you need to draw on it. And also we do an exercise and we say to clients, right, when you do retire, day one, over the next few months, keep track of what you're spending because some people spend a lot less than they think they're going to spend. And then we can then assess, okay, how long is your pot going to last you based on what you're actually spending? What's the day-to-day keeping the show on the road and what's the nice to haves? So there's a lot of work to do, but it's just making sure that you've got that safety net should you need it, but also going forward, what does that look like for you?
Okay, that's good. I'm just going to go back to finish to um, the conversation we're having about DIYing, because something we're often asked about, I know, are workplace pensions or what we call auto enrollment pensions, because anyone who's an employee now is automatically put into one of these workplace pensions. And um, quite a few people will say, I've no idea what this is. Is it any good? Um, should I stay in it? And well, the answer is always yes, because it's free money. If you opt out of it, you might save a bit, but your employer has to pay in equivalent to amount of what you're paying in, and some are more generous than that still. So definitely, if you've got the opportunity to have it, keep it. Don't start another pension. And we wouldn't opt you out and suggest you start another pension with us because workplace pensions have capped charges, so they're cheap. What we do discuss, and this is where the DIY comes in, is looking at the funds in which your workplace pension is invested, um, particularly for younger people. And if you're 30 odd, then you've got another 30 years, well, at least 20 years, maybe 30 years, during which time that money is going to be invested. If you don't do anything, you're going to be in a default vanilla type of fund, because they won't take any risks on your behalf, but you can afford to take more risks if you've got time. So the DIY bit is we will usually say to people, and we'll have a look at what funds are available for you. Don't sit in a boring fund. Go for something which has got more in shares because you've got time to ride out the peaks and troughs. And I'd also say if people have got 3 or 4 of these workplace pensions, put them into your most recent one. Keep it together and you'll keep the charges and you can keep hold of the investment strategy. So we do sometimes recommend some DIYing. I think the other thing just to mention, I think you've both had experience of this, is people who are in what is then the default scheme of default schemes for a lot of employers, the government scheme NEST, the National Employers Savings Trust. So I think both of you have had to have conversations with people who didn't really know how these things worked, haven't you, Louis, Kendra?
Yeah, absolutely. So they are a lot, as you say, a lot of the time the default scheme. It's a ready-made scheme, and it serves a purpose to an extent because it allows, maybe smaller employers to have somewhere they can turn to meet their auto enrollment obligations. It's not the most efficient scheme in the world, I would say, because they charge you 1.8% when you put the money into that scheme, which is quite a high initial charge considering not getting advice or anything. That's quite a lot to go in. The annual charge is quite low, but that initial charge is quite heavy. The other thing that's also worth bearing in mind is that Nest, and not to get too technical, but Nest is what is known as a relief at source scheme. And what that means is If you're a basic rate taxpayer, that's absolutely fine. You're going to get all the tax relief that you are due. But if you're a higher rate taxpayer or you're an additional rate taxpayer, then you actually need to complete a self-assessment to claim some of the tax relief you're due. And the reason for that is when you put money into a pension, the theory is none of it is taxed with your income tax. It should be neutral from a tax perspective. But if you're a higher rate taxpayer, that means you should effectively get 40% tax back, whereas Nest will only give you 20. If you're an additional rate taxpayer, you should effectively have 25% tax, 45% tax back, whereas Nest will only give you 20. And so what it can do, the Nest scheme, is it means you need to be conscious of what you've got. You need to be doing a self-assessment if you're a higher rate taxpayer or more. And I suppose that blends a little bit with what you were saying, what we've been saying earlier about the DIY. If you are DIYing, these are the kind of issues you need to be conscious of. If you had an advisor, obviously we'd be telling you this. But if you don't have an advisor or you're not researching it, you're not going to know it. And that could mean there's thousands sat in a pot. You've already paid the tax on it, waiting to get back to you. You don't know anything about it. So there are some pitfalls.
Okay, that's great. I think that's enough for this week. So thank you, Louis and Kendra. We'll be back with another Q&A sometime soon. If you have any cues for us to A, please do send them in to us either at support@pjamesifa.com or to any of our emails. And see you again soon.